Welcome back to our year-end mutual fund cafe. I have with me the biggest fund managers in the country speaking about the year that's just about to be born, 2016. Well, Prashant, the big sectoral bets for next year, which ones would they be?
I think the economy is changing from high inflation to low inflation, currency depreciation to stability, and from weak capex to improving capex. And I think low inflation adversely impacts consumer staples. So I would say these markets are in transition, and going forward, in my opinion, the investment-led sectors should outperform the consumer and the export-led sectors, because the tailwinds of high inflation and currency depreciation are missing, and the domestic economy is improving, in my opinion.
Okay. Well, Sunil, just tossing that to you. You know, Prashant's top 10 and yours top 10 are like chalk and cheese. There's nothing common. What are Prashant's top? State Bank of India, ICICI Bank, Larsen, Infosys, HDFC Bank, Tata Motors, Bank of Baroda, BPCL, those kinds. And I don't see any of those. Is there anything common at all? No, except Infosys is common.
You are comparing a large cap fund with one of my mid cap funds. That is the reason. So as a fund house, I am very sure we'll have a lot of things common, because there are some obvious names which are there in everyone's portfolio.
Okay, what would be your sectoral bet? Would you say that investment-led and cyclical economy facing, or would it be all bottom-up?
In the first part of the program, you mentioned why mid-caps or how mid-caps have done better. See, one thing we have to realize that we are an evolving economy. And there are some new themes which are getting listed, some new themes which are coming up. And they necessarily start small, you know. And that is where the companies have done well. So our view would be that if India evolves from a $2 trillion economy to a $4 trillion economy, there are a lot of new themes which are going to emerge. So yes, you know, while the traditional, the large caps, and we have a large number of really good, well-managed companies in India, there is going to be an alpha creation opportunity in some of the newer themes. So I am a firm believer that India is moving into a scenario where per capita income is rising, aspiration is rising, you know, the exposure which we have to the global scenario is improving, and we are all now getting, you know, fascinated with some brands. So brands which would be a sort of part of the urban consumption theme is going to be a big play. Capital goods, there is no doubt that India is going to definitely have investments, whether it happens in the next year or 2 years, or as Navneet mentioned, there's a super cycle, we don't know. But it's going to happen. But there our focus would be on companies which have technology and decent balance sheets. So we'll stay away from companies who are in construction but which have stretched balance sheets, and would rather focus on companies who might appear to be a little bit more expensive but who have the technology and the capability of executing if the orders come into play. And obviously, you know, we are bullish on the financial services, but I would rather prefer what Naren mentioned, you know, the wealth sort of parking kind of financial services, so asset management companies, some wealth managers, life insurance companies, and so on. You know.
Okay. What about technology itself? I mean, how do you approach the IT space,
so I think
or even telecom?
No, IT is a decent sector. We are equal weight. Yes, the volume growth has been slightly, you know, coming down. But even now, the companies are growing double digits. And it's a good sector in the sense that all the profit is free cash flow. Eventually, they will start to give a lot of dividends. You know, right now they are conserving, maybe for some acquisitions, we don't know, but if they're not able to do some major acquisitions, the shareholders will force them to give dividends. And it's also a hedge against any disruption which happens in the currency side. So I think it's a decent sector, and you should not write it off. Okay.
Would you write off public sector as a sector, irrespective of
you can never write off some things like that, you know. That's never the case. So, you know, I think if you look at where we were in 2007 and where we are now, you'll find in 2007 people believe that the entire infrastructure will be led by the private sector. Everything will be done by private sector. There's no role for public sector undertakings. 8 years later, if you look at it, it is the public sector companies which are involved in infrastructure which have the best balance sheets. And the private sector companies today don't have the balance sheets to do any PPP. They have to do only EPC kind of projects. So I think there is no case like you can make such blanket statements.
Okay, let me give you a blank check. What would be your sectoral bets? You all spoke about disruption. So as the disruption happens, what will be the pieces you'll pick?
See, I think what we have been believing is that we are right now in a lower return economy till the global economy stabilizes. So you prepare yourself for a lower nominal return and run your portfolios keeping that in mind. And if the whole environment changes and you can never time the bottom, you move to a much more aggressive situation, because you know in the next 3 years things will definitely improve. So we have been actually positioning our portfolios to some extent on a lower return kind of world. So things like regulated utilities where you can't make mega returns, or some of the top private banks which are focused on retail, these have been stocks or sectors we've been looking at because of this lower return perception in the near term. But I think there will be a period in 2016 where we'll have to change that view, because I think we will have to move to a higher return world, and maybe some of the problems which have plagued both the world and the country for the last 5-6 years slowly will get, maybe it will come to a turning point. And so, you know, I think where we are at the end of 2016 could be different from where we are now. Right now we are in a situation where FIs are seller, sovereign wealth funds are seller, foreigners are fed up of emerging market, and locals have been very positive. So I think right now we still believe in a lower return phase, but I think 2016 will represent a turning point. I think clearly NPLs also, the issue should get bottom out in 2016, and on a 3-year basis things should improve.
Somehow when I asked technology and disruption, I thought a little bit of drugs and pharmaceuticals will also be spoken about. Those companies have seen repeated attacks from the drug authorities. Is that a time to buy in distress?
Yeah, clearly you should, but you have to think of what aggregate market caps each of these companies have reached. So you know that, both I would say that Sunil and I have been talking about pharma so aggressively from 2007 to 10. I think this must be the first year where he hasn't talked on pharma. So what happens is that you are in a situation where right now the sector still looks fantastic, because we still don't have a manufacturing export base outside drugs and maybe IT, which is not manufacturing but services.
Yeah.
So how can you fund all your imports if you don't have exports? So from that point of view, the drug industry does look very good. But you know, you have to do much more bottom up. You have to be cognizant of FDA risks. You have to be cognizant of each company's product portfolio. So, you know, I think today that field is also widening. You're seeing a lot of hospital companies come up.
Exactly,
so just
pathological laboratories.
So just the domestic pharma is becoming a bigger opportunity, because the domestic pharma size is only less than $15 billion for a population of 1.3 billion people. You know.
So I think we'll broaden that sector and say the outlook does look very good. But the fact that, you know, now you have to do much more stock picking means that we have more work. And we have to be, and we are very clear that, you know, we have to be cognizant of the risks in that sector. See, if you see consumer sector, although most of us are underweight and we have been negative, clearly the risks in that sector are much lower. And the premium valuations is coming out of the zero interest rate environment in the world, where people say we'll be in a safe sector, earning very low returns. Whereas here we are in a much better sector maybe, but we have to do the stock picking.
Okay. Yes, stock picking definitely, but still there, what would be your sectoral themes, Navneet?
So overall, I focus on stock picking, but if I have to make some broad comments, I would say stay with high operating leverage, and I would still be cautious on the high financial leverage. I think in an economy where you have the high real rates, when asset values are going to grow at a lower rate than the interest that you are paying, you have to be careful on that. Having said that, there will be some technical calls, but by and large, I would say that the kind of transformations which are there in the governance, in technology, in the way of doing business, in the consumer behavior, some of these things I think will provide opportunities for those players who are prepared for this new next India, and those who are still living in the yesterday, I think are going to pay a price. And that's why you are seeing this difference between some of the larger companies versus the more nimble ones. They may be in mid-cap space, but I'm sure some of them are going to become large-cap. Today's large-cap were yesterday's mid-caps. And I think that thing will continue in an economy which is so small. At $1,500 per capita, we are going to be at $3,000, $4,000 per capita. Several of the smaller companies are going to become very big. So I think those who have that nimbleness and have the ability to take advantage of the size of opportunity that we have. I mentioned about the investment super cycle. I think roads, railways, power T&D, renewable energy, urban infrastructure, defense, the spending on all these things, I think over the next several years, India is like really starved in terms of the overall infrastructure. We had a very bad experience of, let's say, the way it got built, and that's why some of the developers who got into the trouble, the asset owners that got into trouble, construction companies that got into trouble. I'm sure the way of doing business there also is going to change. The financial investors, both the equity and the debt guys, are going to look at the cash flows and not the order book the way we looked at in the last cycle. And that will change the way of doing business and the way investment cycle is going to be. And that's why I mentioned that those who have the operating leverage, who can really build the next India, and also the opportunities on the global market. So some of the light industrial goods, we think that some of the Indian companies can do very well over the next several years. Lots of the international companies are looking at India as a base because they are finding that light industrials, or let's say auto ancillaries or chemicals, some of those space could be very interesting.
Chemicals, yes, we have seen a lot of that grow. Now a rapid fire round for all of you. Some guesses on where is the Nifty same time next year?
Plus 15 to 20%.
Okay, that's very positive. Will FIs return?
I think they will.
The domestic funds have been excellent. Your industry itself has grown to what now, 13 lakh crore? By the end of 2016?
I think equity inflows should do extremely well over the next few years. I think they should continue to sustain, and they will actually grow over time in my opinion.
Local investor will keep the faith?
I think so, because equities represent the best performing asset class, and I think slowly the understanding of equities is showing an improvement.
What's your guess, Sunil? Nifty, December 2016?
We might see a new high.
New high. Okay, that's at least a positive. That's more than 10%, even if we were to go by 9,000. Will FIs return?
I don't think they've exited. It's been a sort of a strategic reallocation.
It's been a net, what, 2 billion this year?
But Lata, you have to remember, there have been some oil sovereign funds who have to manage their balance sheet because of the big deficit. And it's fine, we are saving $7-8 billion in terms of monthly oil bill going down, and even we have to give them back their $1 billion, we still have $7 billion left. So I don't think FIs have left, and they would definitely be there.
Has the SIP culture caught on enough?
Definitely.
Do you think this 13 trillion becomes 18 trillion?
See, if you see again this last year, we have seen flows coming in every month. It's not that we have seen flows coming in 2-3 months and they have not come in. And I think that is where the SIPs come into play.
Okay. Naren, Nifty in a year?
No, I've been recommending hybrid funds for 1 year and equity funds for 3 years.
Okay.
So,
all right, 2 years.
2 years, no, I don't give number targets. I believe that if people invest in equity funds, come in with a 3-year view in 2016. And if you want shorter periods of time, invest in hybrid funds, you will get good risk-adjusted returns.
Okay, fine. Do you think the SIP culture has caught on? What will you see your industry as? Since you were the person who told me that it is not banks necessarily, but pools of, savers, saving companies is what you will look at. What will the mutual fund industry look like?
I think clearly we have been trying to give as a good investor experience, and as long as we keep giving investors a good investment experience, I think the challenge for the industry would come on how to manage size. I don't think there's any challenge of collecting money, and we have a huge scope to collect money as an industry.
Finally, Navneet, what returns in 2016?
Difficult to predict 1 year, but yeah, one can guess looking at the valuations and the earning growth, 15% should be reasonable, but you don't get returns in a linear fashion. So over the next couple of years, it should be 12 to 15%, which on a risk-adjusted basis relative to other asset classes look very attractive.
Okay, we'll leave it at that. Fund managers representing half the mutual fund industry are expecting at least a 15% return, definitely new highs for even the benchmark indices, and the biggest gains may still come outside the benchmark indices. Happy 2016 from our fund managers. That's it on this edition of Mutual Fund Cafe. Thanks for watching.